So one of the most underrated things in trading is how you control your risk and how you control your profit-taking systems. Now, everyone is so obsessed with how they get into the market and how they take the trade that they forget just as important is how you exit the trade. But even more important is how you manage risk, because in the end, a trader does not know the outcome of a trade. We are hoping, speculating that it will go in our favor, but the reality is we have to accept it could be a loss. So therefore, part of a professional trader's role is how to professionally manage risk. And as I'm sure you know, you can be a break-even trader in terms of a break-even strategy, but actually overall come out with profits in the market depending on how you manage your positions. If you remember some of my previous videos about the revolving door strategy, we spoke about how a break-even system can actually lead to a lot of profit if you navigate the account correctly. So in the end, this topic of risk management and profit-taking system is essential. Nobody speaks about it. And in this video, I want to go through a full case study of a specific trade and show you a key piece of insight that nobody really does, but actually makes a world of difference. And hey, in this video, I'm not just going to tell you what it is. I think part of the learning process, part of an effective way you will really absorb this information is if I show you first and then tell you, as opposed to just tell you and hope it sticks. So a quick breakdown on how we took this trade. So first of all, you can see EU on the screen. I'm going to be right into M1 just to show you the important portions. But first of all, we have this supply zone over here. We have this run of liquidity zone. We had a build up of liquidity, run of liquidity, and push down. We've identified the order block or refined IFC in there, highlighted as a supply zone. Then the main thing next to do is the Asia range read. We see build up, inducement, push down. What does that tell me? Sellers are in control. Then we see build up and inducement low, push out during Asia low. So that's showing me intent of the buyers, not just to move up as a trap. I'm not going to just simply say this is trendline liquidity, because there's actually intent behind the move. So this is showing me these buyers overpowered the previous sellers and then reaffirmed it here with this inducement low to a push out. So this is showing me buyers are in control. So if I need to take a sell, I need to see significant sellers control supporting that. So what do I see over here? I see a sweep of Asia high with this liquidity over here, with this liquidity over here, sweep of Asia high during my Frankfurt open. And I see that with an inducement and then a small minor inducement over here, build up, inducement, push down. So this is indication that the sellers are in control, overpowering the previous buyer zone and coming all the way down here. So I need to understand, first of all, is this going to be a real supply zone, or is Frankfurt high going to get induced by London high or London open, which is often a case, therefore a trap? So how do I understand the differences there? I look at the correlating pair, which is going to be obviously GU. So I come onto GU, I look at similar price action. And the only difference here is we had not only Asia high liquidity, we also have previous days high liquidity over here. So this is going to be another liquidity pool supporting Asia high. What do we see over here? Inducement low, attacking this bearish trendline liquidity. Build up of liquidity, inducement low. What is this showing me? Buyers are in control. Buyers are in control. Build up of liquidity, inducement of liquidity, push out, buyers are in control. So there's a lot of buyer's strength, but when we do a medium inducement of previous day high and inducement of Asia high, we have a new inducement and therefore fuel. And I need to understand what is the importance of this Frankfurt open. That not only takes out the previous buyer's inducement zone over here, previous demand, not only does it take out those levels, we actually have a full bearish move down and takes out Asia low. So now I need to think that Asia low run of liquidity, is this buyer's inducement again? So there's a lot of things that are in my mind, but the key here, which you've seen in my public signals, I did a lot of my public trades that I took, live call outs, were using this divergence. So when I see this high on Frankfurt open, that is a higher high and an inducement. Here is not a higher high just yet. And then the next move forms a higher high over here, but over here it does not. It respects. So we have that divergence. Price is going down here and price is going up here. This indicates to me this is a manipulation and therefore this becomes a protected high. This gives me clarity to say this could be a real supply zone based on this EU-GU divergence. Now when I see the follow through and I see we have another inducement here and push down, this is supporting to me that this could be the protected high. So even though I have the inducement low, I'm okay with this area. The next thing that I started to think was I had this equal highs buildup of liquidity. One touch, two touch, third touch. We had an inducement closing that last imbalance right here. So we've gone to the protected high, closed that last imbalance on London open after doing an inducement of these highs. And then what do we see right after that? Break of structure, where we have high, small higher low, higher high, lower low. So that shift in structure that we can see, ever so slight, leads to this refined IFC over here with the imbalance, and that's the area I was looking to execute the trade. That's what you saw me think and actually execute upon in terms of a sell limit. Now, this is where things got interesting, because as I started to play price action, price started to retrace into that area, and then once again I need to pull up EU. So here when I'm looking at price action side by side, right here at 8:18 a.m. At 8:18 a.m., what is price doing here? We're forming a high, then a higher high. So we have a divergence, because here we have a high and then a lower high. So when one is going up and the other one is going down, that temporary depeg, just like it happened before, shows me signs of a manipulation and therefore real intent. So if I see that this is the protected high based on the previous divergence, this is cleared that high and there's a supply zone right above, I'm thinking this is a temporary inducement up to grab stop losses, tap into that supply zone and then come lower anyway. So when I look at my preferred pair and I see us doing this high and then lower high, this is showing me this is a real mitigation. This is a manipulation on EU, and therefore I'm safe to trade it because it's an extra confirmation. So when I see that sign of divergence and I see that price is hovering around my entry, just below my entry, a few pips away, and again I'm targeting the M1, but I want to do a quick read of M2, my entry should be here based on the imbalance. M3, my entry should be down here. M4, my entry should be down here based on the imbalance and the doji candle. M5, the same thing. My entry should be down here based on that imbalance right here. So when I see M2, 3, 4, and 5 aligning in the same area and only M1 is different, only M1 is the higher zone, all of the other timeframes are indicating my entry should be here. Larger stop loss than I would want. I'm going for the M1, which is right here. So with that in mind, I'm in a valid zone. And I have the confirmation of the divergence. So I'm thinking maybe I should take an early entry, but I don't want to just market execute and then have a stop loss like this and a scrappy trade, 7 pips, or just enter on the sell limit and then have a 10 pip stop loss the moment it moves down. So I wanted to be a bit more intelligent. And the way I did that is wait for confirmation. So when I play candle by candle, I've got all the criteria I need. Inducement and protected high. Medium inducement of previous day high and Asia high. Inducement of the day in Frankfurt high confirmed as the protected high based on that divergence. Break of structure confirming market structure shift and intent. Build up of liquidity, inducement into a mitigation of the previous supply, and then an internal break of structure over here in the London Open with the divergence. It's looking like a clean intra-session trade. An overall higher time frame is bearish. So all of these things align. I just need to nail the entry, which is obviously critical. This area being the inducement low, this is my worst case scenario. If the market is bullish, it will do something like this. It's done the inducement low. So this liquidity is bullish, retracement, continuation. And if that is the case, I can still sell this portion and maybe I'll be break even or taking a partial buy here. So even if the market reverses on me, I might get that session volatility, even if that trend plays out, which I don't know. So in this case, a lot of confirmations in this trade. It's a high quality setup. I just need confirmation. So I wait and I wait and I see this. Okay, perfect. You're going to have to pay attention on the lower time frame, but this is simply price consolidated like so. It did a bit of a consolidation here. And then what did it do? It did a slight push up, internal break of structure like so. So that's the internal break of structure we're seeing based on the previous candle, the previous higher low that made the higher high internally on 32nd, made an internal break of structure. So this gave me a new target, which is right here. I can enter right here with a stop loss of 3 pips, enter on this close of this imbalance, so tap retracement back in, 3.5 pips stop loss. So that's exactly what I aimed for. And now with that parameter, my 1 to 3 risk reward partial is right here. So right upon that new break of structure, I do my 1 to 3 approximately in this area. And then my 1 to 10 obviously being my full target. And I know that this is my efficiency of the pullback, the demand area that could invalidate my trade and potentially a reversal point that I need to monitor. So this became the setup because I have all the confirmations and EU, the correlating pair, confirms based on this divergence that I can go at any point. So this is the confirmation I needed. And now I took the trade. You can see I'm entering the trade. And then as price is coming lower, it goes very quickly towards my 1 to 3. Now, this is exactly how the market moves. 1 to 3 risk reward will be super sharp if you have a 3 pip stop loss because the average London Open movement is 15 pips, 20 pips. So it's just tap and go. This happens all the time. The problem here became I had a remaining imbalance right here. From that wick to that wick, I have that small imbalance. So this indicates to me that price could come lower, hit my 1 to 3, do a bit of retracement, close that imbalance, and then go towards my maybe 1 to 10 target. Maybe reverse here and make the higher high. I don't know. Maybe it follows that bullish trend and goes higher and hits my trade for break even. However, there is also the possibility that I could get a New York reversal, sweeping into that zone and making the lower low to go towards my 1 to 10 target down here. So with that in mind, I don't want to be wicked out of this trade just for a couple of pips and miss my 1 to 10 targets. So this are the thoughts I'm having. The reason I'm having these thoughts that I don't usually have is because this is an independently valid zone, because it's an area in supply that did a previous mitigation and has a remaining imbalance. Refined IFC, I call this a banker block. So when there's a banker block remaining, I don't want to get wicked out because price can come back and mitigate it and respect that level, and I will be out of the trade. So what can I do here? Normally, I'm going to break even. The moment I have a market structure shift, I should move my stop loss to break even. So therefore, my stop loss will be down here. And if price comes up, it will wick me out with this portion here. So to avoid that, the key here as a trader that pays attention to risk management, profit-taking systems, and how you control your break even, it's not always about just aggressive break even and protect your capital. Usually that's the case, but sometimes you need to apply a little bit of subjectivity and say, what is more logical here? What is the odds in my favor? And you play that probability. And you say the probability of that mitigating this zone and still coming lower is rather high, especially if price doesn't arrive to my blue box first. If price arrives to my blue box first, then the new trend could just be bullish. And price could just go up and make that new impulse higher because that's the trend. We had bullish push up, retracement down, new bullish push. So I don't want to be trading a sell if the market is now switched bullish. But if price did not come to this demand area yet, then the sells are still on. So I wanted to avoid that. So that was my criteria of thinking, and I'm waiting for confirmation. So as price doesn't hit that demand area, continues to retrace. Now it hits that demand area, so I'm a bit unsure. So I have to play my cards and say what's making sense here. And when I see this, I'm thinking, perfect. Now there's more information. Now that I have this liquidity here, this trend line liquidity with 1 touch, 2 touch, 3 touch, I'm potentially seeing this as a sweep of this high, potentially, liquidity of inducement high. And I'm seeing this whole area as this trend line liquidity, this high liquidity, and this is simply an inducement to therefore come lower, like so. So that's what I'm betting on. So all of these things are basically saying I should be careful that price could just induce into this area, induce this trend line, induce this supply zone, and then come towards this low, because the imbalance is right here. So that's the real reason the demand area is here, and I'm not considering this fulfilled, because that's what the price is going to reach towards, is the bullish imbalance in this demand area. So there's still room for price to come lower. So with these things considered, I didn't want to break even, but I've already taken a partial. So let's do the maths here. If I've got 1% risk on the table and at 1 to 3 risk reward, I lock in 50%. That means a 1.5% gain. And you see the live screenshots of my MT4 are exactly that process. You saw my entry, you saw where price was, you saw at 1 to 3, I took another screenshot. At that point, I've locked in 1.5%. Now, when I break even, if price comes back to my entry, I gain 1.5%. I don't lose anything, and that's my take home, plus 1.5%. Now, I don't want to lose my own capital, but I'm happy to lose profit in search of that extra 5%. Remember, if it hits my TP2 at 1 to 10, I'll lock in an extra 5%. So in my head, I'm thinking, is it worth me risking 1%, that is my remaining stop loss, not of my capital, but I've actually P&L secured on this trade, which is that 1.5% at the 1 to 3 risk reward. I'm willing to put up 1% of that 1.5% profit as my risk in hopes that it could reach that 1 to 10. So the risk reward of holding the trade now becomes I risk 1% of profit, not of my account, of profit on this trade to potentially gain another 5%. Positive risk reward. So with these assessments and also a likely candle that could be mitigated based on this inducement of trend line, inducement of this supply and price going lower, I'm thinking this is a solid idea. So I don't want to move my stop loss. I'm going to leave my stop loss there and allow the trade a bit of space to potentially hit my 1 to 10. So worst case scenario is no longer I walk away with 1.5% and a break even trade. Rather, I'll willingly hit stop loss in hopes of that 1 to 10, meaning that 1.5% I've locked in, I could lose 1%. So now my worst case scenario is I walk away with 0.5%. Still a profitable trade, not as the ordinary system, but this is with the idea that I don't want to hit a break even and miss out on a trade. I'm leaving that 1% exposure to potentially get that 1 to 10 and lock in 5% of the remaining volume that I have. So this is how I navigated not a break even, but a break-even trade via a partial. I didn't move my stop loss, I moved my partial. So at certain times, this is the sensible thing to do, and I want you to take this nugget and apply it into your trading system in a sensible way. Don't just do this willy-nilly and hope that, okay, it's always going to come back to entry and I want to leave that. No, this is specific criteria of high probability zones, because you don't want to skew your whole data and now take unnecessarily losses that could have been break-even trades and hold that partial percentage that you've gained. Rather, at times, deploy it in an intelligent way, and that's exactly what this technique technique is. It's selective, it's at specific times, but it's something you have in your skill set that you can deploy when important and overall hope to achieve greater profitability. Now, to summarize this trade, this is not what happened. In the end, price did go on to hit my stop loss, and I can just basically say price, this was the retracement. Price tapped into that demand, narrowly missed, maybe an M15 demand, and started that new impulse to go higher. So in the end, I was wrong, but I had enough reason to speculate this was the sensible thing to do. And in the end, I walked away with 0.5% gain. It could have been a 1 to 10, so I could have locked in 6.5%. So I was willing to put that risk on the table of that 1% of not my money, of the profits secured on the trade, real P&L. So in the end, I didn't damage my account. In fact, I walked away with 0.5%, and I think this was the sensible thing to do. I want you to walk away with this knowledge, apply it directly, and remember, apply it in the correct moments, because as you know, a restricted trader is a profitable trader.